Again? Hey, welcome back to Squirrel School. If you're new here, make sure you hit subscribe to never miss a video on self-managed super funds. In today's video, you'll learn about buying residential property with your super fund and how you can use real estate to grow your nuts for retirement. Owning one or several investment properties is a big responsibility, whether they're owned through your SMSF or privately. Property investments require substantial capital input and often borrowed funds. This can add to the risk profile of your investments as a whole. Now let's take a look at the benefits of investing in property. If you buy the right property at the right time, you can enjoy substantial capital growth and/or positive cash flow. There can be great tax concessions available to SMSF property investors. Property adds diversity to your investment portfolio. Your fund can take out a mortgage under a limited recourse borrowing arrangement to scale up the value of your investments with a smaller fund. You can combine your super with your partner to buy an investment property together. Of course, all investments carry risks, and property investment is no different. Let's take a look at the drawbacks to property investment. There's no way of controlling supply and demand. It can be difficult to differentiate between a good investment decision from a bad one. Real estate transactions are notoriously slow. A fund heavily held in property assets doesn't have very strong liquidity. Property purchases can attract large capital gains tax liabilities. There are a lot of administrative duties that concern your property, from depreciation schedules to ongoing property management and tenant sourcing. There are rules around what types of property you can buy. Your investment strategy. In real estate, there are generally two distinct strategies: cash flow investing and capital growth investing. Cash flow investing involves investments designed to bring in a consistent income stream. This happens when income generated by leasing the property out is greater than the cost of maintaining it, resulting in positive cash flow. Capital gains investing refers to investments that are expected to grow in value. While the cash flow during ownership of the asset may be neutral, the end goal is that the property will be sold for more than it was bought for. Your chosen strategy will depend on how close you are to retirement and what are you trying to achieve with your property purchase. Let's take a look at the costs you may incur if your fund purchases an investment property. Property management costs. To make money from property investment, often you need to lease to tenants who pay a weekly rental fee to live in your asset. A property manager will help with maintenance requests, compliance, and finding the right tenants. Accounting fees. From depreciation schedules to deductions, handling tax obligations of an investment property portfolio is complex. You'll need an SMSF accountant that's experienced in handling SMSF-owned real estate. Legal fees. Transacting real estate is complex, especially when an SMSF is involved. Your fund will need to be able to cover the costs of conveyancing when buying and selling. Maintenance costs. When things break due to general wear and tear, it's up to your SMSF to cover the cost of repair. Insurance. You'll need to have appropriate insurance policies in place to make sure you're complying with legal obligations and protecting your fund from financial liabilities. Stamp duty. Just like an individual, SMSFs are often subject to stamp duty. Stamp duties are a state-based tax. Agent fees. Should you eventually sell the property, you'll need to engage a trusted real estate agent to execute the sale, auction, and open for inspections. Capital gains. As with any asset, when you make a profit upon the eventual sale of the asset, your fund will realise a capital gain. That's subject to tax. Watch our super tax video to find out more about this. SMSFs are permitted to borrow up to 80% of the property price under a limited recourse borrowing arrangement. This facility allows you to keep cash or other assets in your fund while still investing in real estate. Most lenders will require a deposit of at least 25 to 30% of the property value before approving your loan. Lenders will assess your fund's capacity to borrow in a similar way to individuals. They'll look at your fund's previous tax returns and assess income on the fund against the repayments required on the property. Now, this is often combined with an independent rental valuation. Property bought with your SMSF must meet the sole purpose test. That means it must be with the sole purpose of growing the fund for the members' retirements. If there is any present day benefit to the investment, it would be a breach of the test. Let's take a look at the ATO'S rules on buying residential property with your super fund. Now, you cannot buy residential property to live in yourself, and you can't buy your current home either. You can't buy a property from anyone you know or anyone related to you. You can't lease the property out to anyone known to you or related to you. You can't lease the property out for less than market value. You can't benefit from the property in any capacity beyond growing your super fund balance. You can't buy a holiday home with your super fund. You cannot improve or renovate a property using borrowed funds, but you can repair or maintain it. The ATO is pretty strict on all these rules, so always do your due diligence before starting an SMSF or property investment. Thanks for watching today's Squirrel School on buying residential property with your super fund. Go forth and self-manage your way to nutty retirement riches. If you like this video, give it a thumbs up and make sure you subscribe so you never miss a Squirrel School video.